Imagine if every investor was a perfect thinking machine, never scared, never greedy, always logical. Picture a world where every financial decision is made with cold, calculated precision, free from the influence of emotions or bias. Every move on the market would be so as deliberate as a grandmaster's chess play, each step carefully weighed and measured. This is the rational investor, the foundation of classic economic theory and the efficient market hypothesis. According to this model, investors process all available information instantly and make decisions that maximize their returns. It's a neat, elegant idea that has shaped how we think about markets for decades. In this world, stock prices always reflect true value, instantly adjusting to new information. The market becomes a living, breathing reflection of perfect knowledge, where every price tag tells the whole story. No wild swings, no panic, just a perfectly balanced scale of information and price. Every shift is smooth, every reaction measured, as if the market itself is immune to chaos. But if markets are so rational, why do we see bubbles, crashes and emotional swings? Why do headlines scream of panic and euphoria? And why do fortunes rise and fall overnight? The rational investor is a useful model, but reality is far messier. Real markets are full of noise, confusion and unpredictable behavior that theory can't always explain. Real markets are driven by humans, not flawless robots. Our hopes, fears and instincts shape every trade, making the market a reflection of human nature itself. The gap between theory and reality is where the most important lessons are found. Let's explore why and see what happens when human nature meets the world of money. Have you ever felt a rush of excitement when your stock rises, that sense of triumph as your investment pays off and you imagine future gains? Or maybe you felt a knot in your stomach, a wave of fear when prices suddenly fall and your hard-earned money seems to slip away. These reactions are deeply human. They're driven by emotion, not by cold, rational calculation or mathematical models. In reality, markets are powered by psychology, herd instinct, the fear of missing out, contagious optimism, and sometimes even mass panic. Think back to the dot-com bubble. People rushed to buy internet stocks, not because the companies were profitable, but because everyone believed in the story and didn't want to be left behind. But when optimism shatters, panic can spread just as quickly, like during the 2008 financial crisis, when fear and uncertainty drove even solid stocks to plummet. Most investors end up following the crowd, swept along by the prevailing mood, rather than making decisions based on pure logic or careful analysis. Stories, rumours and emotions can move markets just as much as hard numbers and financial reports do. Understanding these powerful emotional forces helps explain why bubbles inflate and burst, and why dramatic crashes keep happening again and again. The market can remain irrational longer than you can remain solvent. Even if you're right about a bubble, the market's frenzy can outlast your resources. Many smart investors lost everything betting against the dot-com bubble because the crowd's momentum was too strong, too long. Being right isn't enough. You need timing, stamina and capital to survive. Betting against the crowd is risky. The market's delusions can last longer than you think. Markets aren't just about analysis, they're about psychology and survival. If markets are emotional, but what about models like the capital asset pricing model, CAPM? CAPM assumes all investors are rational and have the same information, but real investors are swayed by emotion, stories and different interpretations. The model predicts orderly prices but can't explain their wild bubbles or crashes. Most people don't hold perfectly diversified portfolios, they follow trends and biases. Still, these models are useful benchmarks, not reality. They're maps, not the territory, helpful for direction but incomplete. Wisdom is knowing when to use the model and when to look beyond it. Can rational finance help us make smarter choices? Absolutely. By understanding the principles behind risk and reward, we can make more informed decisions about where to put our money and how to grow it over time. Imagine you're faced with two investment options. One is a safe government bond and the other is a risky stock. Each comes with its own set of potential outcomes and uncertainties. You don't have to choose just one. You can blend them, say half in each, to balance risk and return, creating a portfolio that fits your comfort level and financial goals. This trade-off between risk and reward is captured by the capital allocation line, a simple but powerful concept in finance. The line shows that as you take on more risk, you open the door to higher potential returns, but also greater uncertainty. If you're aiming for even higher returns, you can use leverage, essentially borrowing money to invest more than you could with your own funds alone. This means you borrow at the safe rate, using low-risk funds to increase your investment power. With that borrowed money, you can invest more heavily in the risky asset, amplifying both your potential gains and your exposure to losses. This strategy magnifies both the upside and downside, making your results more dramatic. The model provides a clear logical framework for building portfolios ranging from conservative to aggressive, depending on your personal risk tolerance. Even if we're not perfectly rational in every decision, these tools and models help guide us towards smarter, more confident investing, giving us a better chance to reach our financial goals. What if you combine multiple risky assets? That's where diversification shines. Mix a steady utility stock with a volatile tech stock. Their ups and downs can offset each other. If they're not perfectly correlated, you reduce risk without sacrificing return. This is the diversification benefit traced by the efficient frontier, the best risk-return combinations. The optimal portfolio lies on this curve. Combine it with a risk-free asset for even better choices. Modern portfolio theory, don't just pick stocks, build a smart diversified mix. Rational models aren't perfect, but they're powerful tools. They give us a disciplined framework, better than gut feelings or following the herd. Understanding diversification and risk-return trade-offs leads to smarter decisions. The gap between models and reality is where behavioral finance lives, studying how emotions shape markets. Use models for structure and psychology for self-awareness. The best investors blend logic with an understanding of human nature. In finance, a good map is invaluable, even if the terrain is wild.